The world of gold investing is rife with misinformation and deeply ingrained myths that can lead unsuspecting investors down a costly path. These false beliefs, often perpetuated by biased sources or a lack of understanding, can undermine even the most well-intentioned investment strategies, resulting in significant financial losses. It's essential to know the right things before investing. Welcome back to the Gold Protocol. Today, we're debunking the most pervasive and damaging gold myths, exposing the fallacies that can drain your investment returns. By separating fact from fiction, we'll empower you to make informed decisions, avoid common pitfalls, and build a more profitable gold portfolio. Understanding the proper facts will protect investments. Myth 1. Gold is always a safe haven. While gold often performs well during economic uncertainty, it's not a guaranteed safe haven in every crisis. The safe haven narrative is not always true. Correlation isn't causation. Just because gold has historically risen during some crises doesn't mean it will always do so. Correlation does not create causation. Liquidity concerns. In severe market crashes, investors may be forced to sell gold to cover losses in other assets, driving down its price. Liquidity is not always a guarantee when buying gold. Myth 2. Gold is a perfect inflation hedge. Gold is often touted as an inflation hedge, but its performance can be inconsistent, especially in the short term. Hedging against inflation isn't always easy to do. Short-term volatility. Gold prices can be volatile in the short term and may not always keep pace with rising inflation. It will vary depending on the prices in the markets. Interest rate impact. Rising interest rates, often used to combat inflation, can make other investments more attractive than gold. Interest rates have a direct impact on investments. Real versus perceived inflation. Gold's performance is often driven by perceived inflation, which may not always match the actual inflation rate. Perceptions versus reality is a constant issue to keep in mind. Myth 3. Gold only goes up. This is perhaps the most dangerous myth. Gold prices are subject to cycles and can experience significant declines. The cost of gold is up and down and depends on markets. Market cycles. Like any asset, gold prices are influenced by supply, demand, and investor sentiment, leading to cyclical patterns. The market cycles continue and affect all assets, including gold. Price corrections. After periods of strong growth, gold prices are often subject to corrections where prices decline sharply. Price corrections is just one component of market economics. No guaranteed returns. Gold doesn't generate income like stocks or bonds, so returns rely solely on price appreciation, which is not guaranteed. There are no guarantees when investing, especially with gold. Myth 4. You need physical gold to invest. While physical gold has its appeal, there are many other ways to invest in gold, some of which may be more convenient and cost-effective. There are always different options in the real world. Gold ETFs, exchange-traded funds, ETFs, offer exposure to gold prices without the need to store physical bullion. ETFs affect gold and its impact on money. Gold mining stocks. Investing in gold mining companies can provide leverage to gold prices, but also carries company-specific risks. Mining is also another option in the market. Paper gold. Futures contracts and other paper instruments allow investors to speculate on gold prices without owning physical gold. Paper gold affects different monetary markets. Myth 5. Gold is always a good investment, regardless of price. Buying gold at any price is a recipe for disaster. It's crucial to assess its value relative to other assets and economic conditions. Prices are always changing and always being influenced by various circumstances. Overvalued markets. Buying gold. When it's trading at historically high valuations increases the risk of a price correction. There is always the risk of prices shifting and changing. Opportunity cost. Investing in overvalued gold may mean missing out on better opportunities in other, more undervalued assets. Opportunities will pass, and it's best to make wise decisions. Protecting your investments by debunking the myths. By understanding and debunking these common gold myths, you can approach your gold investments with a more realistic and informed perspective, increasing your chances of success. For more insights and strategies to maximize your gold investment returns, subscribe to the Gold Protocol. Thanks for watching.